Hello and good evening. In this video we will have a look at a Polish company called Dino Polska, and the reason I tell you this right now is because the share price of Dino Polska has dropped to its lowest it has been the last decade if you measure it in comparison to what it's earning. So Dino Polska has been an all-time favorite in Poland for many years because the owner, who owns a bit more than 50%, has grown this company and the amount of stores, as you see here, enormously from humble beginnings until now 3,000 stores and 3,200 within the year of 2026. They have a very simple franchise. They are profitable at maybe operating margin of 6% or so, and it's down from 8% before. And I believe that that's maybe why the market sentiment is also lower now. So, but this is a company that has no debt really, and they own their own land that they have the grocery stores in, and you can see that the profitability is really high, around it's a bit below 20% now, but it has been very good on the average numbers. And also the growth for the investors has been very high, as you see, almost 20% per year. And if you measure the growth of the operating income, then it has been, I would say, really strong. You see it from, let's say, 300 million in 2017, and then you have now 2 billion in the last 12 months. So that's the sentiment is maybe a bit worried that the operating margin has dropped somewhat, as you see here below, and also there's been some news in the Polish media that some employee issues, that they maybe are not being paid well enough, but from my research, seeing their wages and the competition and the areas where the stores are, to me it looks normal. And it's also some problems where the employees said that the temperatures have been too low, for example. Sometimes companies have temporary problems that can be fixed. Anyway, this is a company that has a very solid balance sheet. It has an equity of roughly 9 billion, and it has roughly 15 billion in tangible assets, the stores and the land and inventory roughly, and the equity, you see, is roughly 9 billion. And with those 9 billion here, they have a profit after tax of roughly 1.5 billion, and the EBIT is roughly 2 billion. And all of this cash flow, that is roughly 2 billion, I believe, now every year, a bit less maybe. But they reinvest everything into new land and new stores that they operate themselves. You see it here, roughly 2 billion reinvested now every year. To build roughly 300 stores per year. Then I do this year after year, and taking the market here in, for example, you see around here in Poland. This doesn't show all of the stores, but you see that they are only in Poland and they build around in the districts, but not in the cities that much. So that's the business plan. Seems to me that if you measure just simple, you can use price book, and you can use return on equity, and you can also use the figure I like to use, the EBIT, compared to what it costs to buy the whole company. I can show you the graph here. Then you see it has been really high before, 38 in multiple for this type of business. That's really, really high. So now it's maybe down at a more normal level, but maybe even at a low level if they can sustain that growth that they've had in the past. So give it a thumbs up if you like that. If it was a new idea, or if you are looking back at the stock again now and you see that the price looks more appealing to you, feel free to comment below, or comment below if you see that there's some news that we are missing. that may slow the growth, or maybe the competition is tougher or what. But to me, Poland looks to be getting better and stronger, and the household economies and it looks like the purchasing power of the Polish residents will be at least as good in 5 years and 10 years from now than it was 10 years ago. So and even now, so I think that it looks pretty strong, and you own the real estate here and no debt, and it's very profitable at almost 20% return on equity. Okay, see you in the next video.